As I was organizing the data, I realized the US market has become incredibly complex. Stock prices are fluctuating wildly, news reports explosive AI investment growth while we're simultaneously hearing about massive layoffs. At first, I was confused about what was happening, but after digging into the data, I realized these market events aren't just temporary fluctuations. First, let's talk about the employment situation. As of November 6, 2025, U.S. corporate layoffs in October reached 153,074, a staggering 183% increase from the previous month. This data comes from Challenger, Gray & Christmas, a job placement firm, and represents the largest scale since 2003. Here's something interesting though: government sector layoffs accounted for 308,000 jobs, roughly 28% of total layoffs. Total layoff announcements through October reached 1.1 million, but excluding government cuts, the private sector accounts for 792,000. While this exceeds 2022-2023 levels, it hasn't reached pre-2008 financial crisis levels, making this a nuanced situation. The problem isn't just rising layoffs, hiring is simultaneously declining. According to Challenger data, the 12-month rolling sum of hiring plans stands at 508,000, barely different from September's 491,000 lowest since August 2012. Experts view this as a transition from low hiring, low firing to less hiring, more firing. Major companies like Amazon, UPS, and Target have announced significant workforce reductions in warehousing and distribution, even as the year-end shopping season approaches. So why are companies cutting so many jobs? It's because of AI. Cost reduction and AI technology adoption have been cited as primary reasons for mass layoffs in multiple earnings reports. Here's the paradox: AI investment is actually exploding. Let me give you an example. There's a company called Iris Energy Iron, originally a Bitcoin mining company. On November 3, 2025, they announced a $9.7 billion AI cloud contract with Microsoft. The agreement involves building a 200 megawatts data center at their Texas Childress campus by 2026, with sequential deployment of NVIDIA GB200 GB300 GPUs. It's a 5-year contract with 20% upfront payment, approximately $1.9 billion. Iris Energy's FY26 Q1 results July to September 2025 are even more impressive. Revenue hit $240 million, up 355.1% year-over-year, with earnings per share of 15 cents turning profitable from minus 27 cents last year. Bitcoin mining revenue reached $230 million, 365.8% YoY, while AI cloud services generated $7.3 million, 4.3% QoQ. They're operating 2,067 GPUs now and plan to expand to 140,000 by end of 2026. The Microsoft contract is expected to generate approximately $1.9 billion in annual recurring revenue, arranged by with an 85% EBITDA margin. An 85% EBITDA margin represents exceptional profitability. These cases suggest AI investment is hugely profitable, yet the market is experiencing renewed AI overvaluation concerns. On November 4, 2025, the Nasdaq plunged 2%, marking its worst day since October 10, with AI-related stocks broadly declining due to valuation pressures. Anxiety intensified when news broke that Michael Burry of Big Short fame took short positions on Palantir and NVIDIA. Palantir's stock plummeted despite beating revenue expectations, while Qualcomm fell despite solid earnings due to concerns about potential Apple deal losses. The OpenAI situation is even more telling. On November 3, 2025, OpenAI CFO Sarah Friar told media she hoped banks, private equity, and even the government would guarantee funding for AI chip purchases. However, White House AI and crypto czar David Sachs immediately dismissed this, stating there will be no government guarantees for AI. The next day, November 4, OpenAI officially retracted the statement. This controversy reignited concerns about OpenAI's ability to fulfill recently signed major contracts, causing partner stocks like Oracle to decline. Meanwhile, signals suggest AI competition is intensifying. Alphabet announced it will unveil its 7th-generation TPU Ironwood within weeks. This chip reportedly improves training and inference performance by over 4x compared to 6th-generation TPUs. It can be configured in superpods connecting up to 9,216 chips. They also revealed that major customer Anthropic plans to use up to 1 million new TPUs to run its Claude AI model. This signals the full-scale launch of custom semiconductor development competition to reduce NVIDIA GPU dependency. NVIDIA stock fell over 3% on this news. So what's the Fed doing in all this? Actually, the Fed is in quite a predicament. Cleveland Fed President Beth Hammack stated that inflation remains high and poses a greater risk to the Fed than labor market cooling. She believes inflation will take 1 to 2 years to reach target levels, and after nearly a decade of below-target inflation, there's risk of high inflation becoming entrenched. She argued interest rates should remain somewhat restrictive, but current rates are barely restrictive. Chicago Fed President Austin Goolsbee also expressed discomfort with further rate cuts given the absence of official inflation data. Here's the critical issue: the federal government shutdown. As of November 6, 2025, the shutdown has reached day 36, the longest in history. The shutdown has delayed official economic data releases. While employment can be somewhat tracked through private data like Challenger layoff figures, inflation indicators require extensive aggregation and lack reliable private alternatives. Consequently, the Fed sees evidence of weakening employment but cannot adjust policy without confirming inflation data. Markets expect rate cuts, with Fed funds futures showing December rate hold probability dropping to 29.1%, but the Fed's cautious stance increases uncertainty. Interestingly, November 5 election results tell a story. Democratic Socialist candidate Zoran Mamdani won the New York City mayoral race, and Democratic candidates also won gubernatorial races in New Jersey and Virginia. Plus the Georgia Public Service Commission chair election. NYC mayoral race turnout hit its highest since 1969, and in battleground Virginia, the Democratic candidate defeated the incumbent Republican governor. In Georgia, a Democratic candidate who emphasized solving high electricity costs over partisanship won. These election defeats prompted President Trump to summon Republican senators to the White House, pressuring them to resolve the shutdown. He viewed negative shutdown sentiment as causing electoral losses. Senate Republican Whip John Thune announced plans to bring a shutdown resolution bill to the floor on Friday, November 7, with potential Democratic support. Meanwhile, developments in China warrant attention. MSCI announced its periodic rebalancing, marking the first net increase in Chinese companies in 2 years. 26 companies were newly added while 20 were removed, creating a net gain of 6. Among these, 13 are AI value chain companies: semiconductors, humanoids, electronics, companies like Foundry Huang Semiconductor, Humanoid Uptech, and PowerGrid Goshen High-Tech were newly included, likely increasing future global passive fund purchases of Chinese stocks. Even more striking is NVIDIA CEO Jensen Huang's statement. On November 5, 2025, Huang warned that China could overtake the US in AI competition with government policy support. Indeed, China has structural advantages: low electricity costs and relaxed AI regulations. The Chinese government is guiding various industries to integrate with AI through its AI Plus action plan. Even automotive companies like XPeng unveiled a female form, Humanoid Iron 2, demonstrating movements remarkably similar to humans, confirming China's robot technology has reached global top-tier levels. So what should we watch for? 3 major contradictions are operating in the market right now. First is the data vacuum paradox. Without official indicators due to the shutdown, there's excessive reliance on private data, clouding market judgment. The Fed sees employment weakness but cannot change policy without inflation data, while markets expect rate cuts. But the Fed says inflation is the greater risk this mismatch continues. Second is the gap between AI growth and profitability. While cases like Iris Energy's $9.7 billion Microsoft contract prove monetization is possible, OpenAI's government guarantee controversy and Burry's short positions signal valuation reassessment. Alphabet's TPU and China's AI progress mean intensifying competition, ultimately creating profitability pressure. Third is the conflict between employment and AI investment. Companies are increasing AI investment like Iris Energy expanding GPUs from 23,000 to 140,000 while simultaneously cutting workforce. With cost reduction and AI adoption cited as primary layoff reasons, AI growth structurally causes employment weakness. The next 2 to 4 weeks are crucial. Once the shutdown ends and November employment data releases, uncertainty will substantially decrease. The Fed can then establish clearer direction. Short-term sector rotation is moving funds from tech to healthcare stocks like Merck, Pfizer, and Eli Lilly Rose. But this reflects defensive sentiment, not a full-blown bear market signal. China's AI sector also deserves continued attention. With improving technology, policy support, and cost competitiveness, global capital is beginning to flow in. The US-China summit's one-year truce agreement also limits near-term escalation risks. One final note on Eli Lilly: they and Novo Nordisk reached drug pricing negotiations with the Trump administration on GLP-1 obesity drugs. Starting in 2026, prices will drop from $350 to $245 monthly in exchange for 3-year pharmaceutical tariff exemptions. GLP-1 drugs currently excluded from Medicare and Medicaid will gain expanded coverage from mid-2026. This represents a blueprint for Trump administration corporate negotiations.